All right, today's the day where we throw ourselves out on the skinny branch. If you watch the preview, you know what we mean by it. And I'm going to stall because I don't really know that I want to have this conversation. And yet it's
You can't stall. That's like the squirrel. When the squirrel's going to jump onto the skinny branch, he doesn't stall. He just goes for it.
Okay, so here's going for it. Today we're going to talk about the compound effect on real estate versus the compound effect on the stock market. And the reason it feels like the skinny branch is there seems to be people in both camps. And then there's those of us that live in both camps, kind of in the middle of the skinny branch, not sure whether to go this way or that way.
Indecision will kill the squirrel. He'll fall.
I know. So anyway, it's going to be a great conversation. And I am Yetta Decker.
I'm Ken Decker.
And I'm Candace St. Louis.
Used to be Decker. Yeah. She usually says that. So I was waiting politely and couldn't wait too long. So
there we go.
How many years has it been now? 8?
No.
How many years I've been at St.
Oh,
Louis?
no. It's a lot more than 8.
It's over 12.
Over 12.
Yeah, good job.
Very good job. The children are older than that.
I told you, I don't look after the years.
No, I do. So compound effect actually cares about years.
Yes, it does.
Because the years, if you're doing it right, so the compound effect on anything in life can really work against you or it can work for you.
Yeah, so I don't follow the stock market real closely.
Not anymore. You have at times when we've
Well,
had
when I got money in
investments.
there, when I get too much money in there.
Yeah. Then
now I've lost most of it, so it's okay. I don't look at it anymore. That's horrible to say, but it's true because what I didn't do was put money into diversified onto the stock market. Like if the safest thing is to do the S&P 500 exchange, which basically gives you a blend of all the stocks on the market. So some go up, some go down, you get the average. Well, I put all my pennies in the wrong stock and it went down to 0. So, yeah.
I know. I know all about it.
Good thing this isn't when you're first hearing about this on the show, right?
That's good because that's happened to me. Has that ever happened to you where you hear about something that is like really potentially a big deal in your world, but you hear about it in front of a room full of people or on the air and there's nothing you can do but smile?
Well, sometimes I say it on purpose then because I know there's nothing you can do.
I know. I get it. I know how it works. Yeah. And so we've been helping families for decades, well, over 2,380 of them, families and individuals, really make great sound financial investments. And part of it really has been with the philosophy of the compound effect.
Well, and birthed out of our mistakes and our wins.
Right. That's why we're sharing a mistake.
Yeah.
And yeah.
So the stock market. Interesting enough, the last 5 years, that's as of January, in the beginning of January, I looked at it, and the stock market had gone from 13,747 to 14,804, which is a 7.7% increase.
In 5 years.
In 5 years. Not per year.
Altogether.
Total.
Altogether.
Okay.
7.
You laughed.
7. I laugh, yeah, because that's not very much.
So is the laugh a nervous laugh?
Well, then I looked at real estate because I thought, real estate's been on a bit of a...
Stable in Ottawa market.
Yeah, but not going up much for quite a few years. Last year, not too bad. But it's been pretty stable, as in not going up. So I thought, what's it gone up? So I looked, and the average sale price in January of 2014 was $347,037. I know you hate the $37.
Oh, just go with the numbers because if people are listening,
they're not going to remember that?
No. And even if they're watching the show on YouTube,
guy, I need to be accurate.
Oh, you're accurate, all right. So give me the round number again, please.
347,000.
Thank you.
For 2014.
January 2014. Yeah. So 5 years later, end of December 2019.
Okay.
Average sale price.
2018. Because we're not at 2019 yet. Yeah. So we were laughing on an earlier show that it takes Ken 3 months or so
And now
before
I'm
he
ahead of
gets
myself.
right. And now you're a whole year ahead of yourself.
Well, because I'm stuck in 2019 now. I'm being
After
present.
talking about
yes.
it.
So back in December of 2018,
Yes.
the average sale price was $402,415. So you can round that to 402 if you want.
Yes.
Please and thank you.
And that equates to a 16% increase for
So give me the two numbers again.
7.7%
Yep.
and 16% increase.
Right. And then give me the average sale price in 5 years ago.
347.
347, and now it's 402.
Yes.
I can do that. I can do that math.
That's about...
I'm doing this for you too because you may be like me and you need the simple numbers.
Okay, so for quick math, that's about 55,000.
Yeah, I did that part.
Yeah.
Ooh.
Yeah.
We're on the same page.
And if you've read the wealth formula, you'll know that there's also leverage involved with the real estate that there isn't with the stock market. And we'll touch on that briefly.
Right. And the leverage just really means, well, that you're really making you're making money with other people's money.
Yeah, I like
right?
that.
That's the simple piece, right? I mean, what do they call it? Opium?
Yes.
Other people's money? OPM? So you can make great money. Whereas the stock market, you can't really leverage because if you use other people's money, it's really risky. Because it's risky. Scary. Scary risky. That's like more than the skinny branch. That's like that new tiny piece of growth, and you fall hanging on to the piece of leaf. Yeah, no, we're not doing that. Skinny branch, I get. No. Okay. So one of our investments, which is a great opportunity, really, to share with you something we did exactly in that same time frame. Well, about a month before the end of 2012. 2012? Yeah. So for 5 years, we got to, just over 6 years, we got to watch our property. So almost in alignment with this same time frame, just a little bit earlier.
Yeah, but the numbers guy is going to do an adjustment for that.
Oh, of course he is.
Yes.
Ken's going to do an adjustment. And when we say he's the number guy, Candace and I do numbers. We just do more general numbers, whereas Ken gets totally... If you haven't nosed, jazzed.
And excited, yeah.
Did you hear that excitement? It was like, it's his thing. And it doesn't mean we love watching other people build wealth and we love building wealth ourselves and using the numbers to our advantage. And yet the scrutiny of the numbers, just the numbers itself, Ryan and Ken both get totally worked up. Yay! So the property we bought in October of 2012, we purchased it for $315,000.
You gave away Candace's part.
No, that's okay. I'm
allowed to say that part.
So Candace, when we bought this property together.
Yeah.
Right. So it was a joint investment.
Yes, and to protect the innocent and the not so innocent, we're going to not give the actual address.
Yeah, fair enough. So we were, I remember the day very clearly. Yetta says she doesn't as much, and I know why. I was a little traumatized. As much as I wanted to have an investment property down the road, I didn't think the day I was driving her to the airport was the day I was going to buy an investment property.
Oh, tell us more about that.
So as I'm on the way to the airport, luckily I was in the car with my husband, we drove by a house and Yetta saw a for sale sign and she goes, I want that.
Was I with you?
No. She goes, I want that and you buy it for me by the time I get back. And I was like, excuse me? She's like, I don't care if we have to buy it together. We can do it and just buy it. And my husband's like, well, we always said we'd buy a rental property. I'm like, yeah, not today. And I was like a couple years down the road. And so we made it happen.
And just to take me out from underneath the bus
a
little, is that fair?
Okay.
Okay. And we had been talking about and knowing that if a property in that area was going to come up, we would be interested in it because it was close to another property we owned and we saw opportunity specifically to do something with it. So it was kind of part of a dream. It wasn't just like a wild whim.
I think it was definitely part of a dream for you and Dad.
Yeah,
I don't think at that point Sasha and I were involved in that dream.
you weren't.
No.
No.
So to me, it was out of the blue. For you, it was planned and strategic. Yes.
Well, planned and strategic. It was a dream, and then there was a piece of my dream, so it felt like a very natural step, not like a random bad choice.
No. Yeah.
Right? And it turned out to be a pretty good choice.
It did. Yeah.
And yet we never did realize the dream that we had with it because things changed.
Yeah,
So-
it just became an investment property.
Yeah, it really did just. And that wasn't a bad thing. It became a good investment property.
So what was the price at?
So it was priced at $300,000. There was 5 offers. So
5?
pressure on me to get the property when she's out of town.
Good thing we're a real estate family.
Yeah. So we did our homework really quickly. We looked at the value. We got in touch with our mortgage broker, and we put everything into place with a very, very clean offer. Which
Like a totally clean offer.
totally clean offer.
What's a totally clean offer mean
A totally
for
offer
people listening?
means that you put the closing date they would like, you put in the price that they would possibly like, the seller, and you put in 0 conditions because that's what a seller likes as well. So,
And a big deposit.
and a big deposit, yeah.
So I taught you well. Like what I'm hearing here is that you know exactly what to do. And even then, 6.5 years ago, which you'd already been in the industry, 4 years then,
Yep.
you knew exactly what to do, even if your mama threw you
And so if your
Curve.
mama's the
Yeah.
client,
Yes,
you got the house for her at
Yeah.
$315.
yes.
Now that's an important number to recognize because a lot of investors say, oh, the only way an investment's a good investment is if I buy it below market or relatively inexpensively, right? Here we are. We bought this property for $15,000 over asking.
Yes.
And did that scare you a little bit?
No, because of my history of working with clients, and I knew the market, it was fair market value at that price.
Right. And also if 4 other people wanted it, you know that 300 probably was a very good price at the time.
Yeah.
like below market.
Yeah.
And so that's an important thing, as Ken was saying, investors, and we ourselves are one, or are 3, I guess, sitting in this room, often think it does have to be purchased at less than asking. And it has very little to do with more or less than asking and more about, is this good value? Is this logical? And then even Ken's point about it being below market value, I don't think we purchased it below market value. Sometimes investors have a rule of thumb.
No, at
maybe
$315? No,
No.
I think we probably bought slightly above market value.
we probably did pay slightly above market value. And yet, having said that, it has still worked out to be a great investment over the last 6 years.
Yeah.
So there's so many other factors to think about. We don't want to get so pigeonholed because then we lose the ability to utilize the compound effect,
Right.
the year over year.
So now I'm going to talk about that and what actually happened with that property. Because now we can take that property, I'll make an adjustment. You'll love this, Yetta. Because it's 6
Will Candace love it too?
yeah, she'll love it because it's all about numbers. Because it was 6.33 years as opposed to 5 years that we're comparing in the stock market. So when I give the numbers, in the end, I'm going to take off 26.6%, which is then going to equalize it to a 5-year period.
Widen those eyes again.
Oh my goodness. If you're not watching, you actually will want to watch this show because there's a lot of facial expressions that are taking place here because it's a bit much.
Okay, so here we go. Here's the numbers. So on a 315 purchase, 20% down is the minimum you can do on an investment property. That is $63,000.
Okay, thank you. You're going to do the numbers.
You're really fast at estimating.
I know,
though.
estimating, but you're not allowing me to estimate. So no estimation, you can do the math.
And I threw in an estimate about $5,000 for closing costs. So that would be $68,000 invested.
Yes.
So now let's look at what happened to the price.
Right. And to our 68,000. Right? That's the part we're really concerned about is what happened to our money.
We're concerned about that? No, I'm concerned about what happened to the property because my money's in the property now.
Well, both.
Okay, both. Candace, what happened to the property? Because we just actually, it's closing on February 28th.
Yep.
What did we sell it for?
So we sold it for $391,000.
Woohoo!
Yeah. After 6 years.
Yeah.
Yeah. So
6.33 years or something?
Yes.
Yeah,
so we
something like that.
decided that it was time to simplify at this point of that property and release it and make our money.
Do
Right, and
something
to
else
use
with
our
it.
money for something else because the dream that Yetta had for it, she now has realized that property doesn't really play into it.
Right.
And that
Doesn't
it doesn't really have a significant impact on the overall. So the dream's still there, still intact, and that property no longer is
Right.
an important piece of it.
So how much did it go up?
So it went up $76,000.
76. So we had 80, no, what did I say? 68.
Yeah,
Dyslexic
68,
there for a second. I was going to say 86.
62,000.
68,000. And it went up 76
Right.
in 6.33 years, right?
Yes.
That's cool.
Okay.
That's fantastic.
That's fantastic. Very good.
Right, because we really and you've got it in under 6, well, just over 6 years, we more than doubled our money.
Yeah.
Which means we're working at way better, well, a little better than the rule of 72, right? Like working with that, it took us just over 6 years, I guess, to double our money.
Right.
That's good.
That's really good.
I like that.
Yeah.
But there's more, right?
There's always more.
Right, because there is always more in real estate. That's why real estate is so exciting, because our mortgage also got paid down.
Yes, because it was an investment property, we had a tenant in there. We had some challenges once in a while, but pretty much the property cash flowed. In other words, what we brought in, we paid out.
Right.
Now,
pretty close.
Pretty close.
Yep.
There was years where we put a little extra in, and other years where there was extra left over.
Right.
Yeah.
So our investment, $68,000, left a mortgage of $252,000 when we took off the $63,000 we had put in as a down payment. Our payout, I believe, is right around $198. Am I correct? Close?
I think so. Yeah.
About $198 when we close at the end of February. So that's a difference of $54,000. Then there's about a $2,000 interest payout for breaking the mortgage early. So that's another $52,000.
I know that somebody else paid off
Right.
on our investment property.
Right. So now if we take the 52 and add it to the 76,
Right.
that's 128,000 in equity growth on our 68K investment.
Now the numbers get good.
So that's 188% increase.
Woohoo!
That wasn't enough woohoo, Candace.
Well, okay, call us today, 613-860-4663 to make your investment.
Well, because if we can do it, you can do it.
Yes.
Especially with our guidance, because it's not just this one example. We could give you example after example after example, and we've got a sound one to give you as one that we actually were all invested in, and one that we didn't think we had actually, well, we knew we had not under purchased, meaning we didn't get a super duper deal on the front end. We paid over asking and all that sort of stuff, and look how good it turned out.
Now we've got to adjust.
Okay.
Remember, because that's 6.33 years. We've got to bring it down to 5 so we can compare to the stock market.
Okay.
See? So we take off 26.6%, which brings it down to 138% increase.
Well, I'll take that.
You'll still take that? Over a 5-year period, as compared to the 7.7%
increase for the stock market?
Yes.
Yeah.
Right.
So that is actually 17 times the rate of return that the stock market, the average stock market in the Toronto Stock Exchange has increased over the 5-year period. Now it's volatile, so it could be, it could be higher later and it could be lower later, whatever.
Yeah.
But that's a 1,700%.
Okay, now the numbers even confuse me, and I deal with them every day. So can you just go through it one more time, slowly and methodically, for anybody that might be like me?
Go through what?
The numbers. Just
the numbers?
do the numbers again, one more time, slower,
we
with
invested,
a few pauses.
Okay, so I'm just going to make it simple numbers. We invested $68,000 between the two of us.
Yeah.
Well, I think there's
the three of us.
And actually, and Candace's husband was part of it. Don't exclude him.
Okay, as a matter of fact, I'm not even on title.
No, you're
so
not.
I didn't make any money.
No, you didn't.
No. So between the two families, this is what we did. Yeah.
Thank you, Candace,
You're
for
welcome.
clarifying, because we need some help.
And that can help actually for some people that go, oh, I don't quite have enough to invest, or I'm too afraid to invest. Sometimes going in with another family member or a partner is a way to buy a better property because you have more down payment. And
it's sometimes just the opportunity for you to even get into the market. Right. And if you can do it with somebody that's seasoned, that already has a track record of making great decisions most of the time, because you've heard some of Ken's and my foibles, so we haven't always made great decisions.
Nope.
And for the most part, the real estate market has served us incredibly well. I don't think we've ever done badly there. Oh, one little $60,000 property that caused us some significant grief.
Well, we came out okay on that one. No, I was thinking more the land development one that we lost some money on.
Right, let's not.
But that was speculative investing. It's not real. It's not this kind of investing. No. Totally different kind of investing.
Right. So speculative real estate investing. Who does that now?
Not me.
Right. That's what I thought. That's good.
It sounded good at the time.
Not to all of us.
So. You wanted the numbers. 68,000 invested, 128 realized in return in 6.3 years.
Okay.
Right.
That's good. That's like more than good.
Yep. Now, that 138% increase, some people say, yeah, but there's real estate fees.
Yes.
Right? Like I did take off the mortgage payment fee. Yeah. There are real estate fees. And what I realized as I was putting the numbers together for the show today and preparing, that yes, there may be 5 or 6 or 7% or whatever fee to sell the property with your legal and your commissions and whatever. But when you look at the stock market and you're in a mutual fund, that mutual fund will take between 1 and 3%, but typically 1 to 2%, will go to fees every year, whether you sell it or not. So that's 7.7% that it made over the 5 years. If you were in a mutual fund or stock where you were paying a management fee, that 7.7 is gone because they would eat it up each year.
Totally gone?
Totally gone, maybe even negative, because the fees that they charge every year, people don't recognize it's only 1, 2, 3%, so they don't think it's much. But it takes off every year from your ability to compound your rate of return. So they're paying their fees gradually over time. And they go, yeah, but there's no charge when I sell. Yeah, but that's because you paid it every year.
There's been a compound effect of being money really effectively being taken away from you.
Right.
Every single year.
So in the long run, because you hold real estate for a long period, the fees for disposal are relatively inexpensive compared to your fees for holding stuff in the mutual fund.
Right, because in our case, we're having it for 6 years. Let's say it's about 1% per year. If we had it for like 20 years, right, which is often what we have done with other investment properties and would often recommend, just in this particular case, the best thing was to use this money elsewhere. You're looking at like 1/3% per year in terms of disposing of the property.
Yeah, it's super cheap actually.
Right. super inexpensive. I think cheap's not the right word, but
You don't want to be called cheap?
Over long term, it's super inexpensive to pay that real estate fee and the lawyer fees.
And then potentially
but it seems like a large number at the time because it's all together at once.
Yeah, because it is a large number.
Yeah.
And then the other cool thing around real estate is because you're not paying until you actually sell the property.
The tax you're talking
the
about?
The tax for the property. And you're getting it at a preferential tax rate.
Yes.
Capital gains. You're actually paying a lot less tax on the income earned.
Right.
Which is part of the compound effect of why it works so well.
Yes. Because you don't pay any tax until you dispose of it, which is similar if you're in a stock or that you're not selling.
Correct.
You don't pay tax on it until you actually sell it, and it would be capital gains in that case, unless it's under an umbrella like an RSP or a TFSA. TFSA, there's no tax.
Right.
Right. But if it's under an umbrella of an RSP, then you don't get that preferential tax treatment when you resell. And that's why RSPs, you got to look long and hard at them if they actually fit your financial situation. And it's important to get advice from a financial planner that you really trust and know, right?
Yeah, because we are not one.
No.
Right? That we want to make sure that you know.
We are not financial
We
planners.
are not financial planners, and yet we are investment specialists, and we have thrived and helped so many clients thrive in the real estate investing in particular.
And we're also not accountants, so get your own tax advice. But the beauty
because we do.
Yes, we pay a lot. We have a chartered accountant and pay for my tax advice all the time. But the beauty is when you sell a property and you have capital gains, that capital gains is at 50%, not 50% tax rate, but 50% of your highest tax rate that you're going to pay. So if you're at a 32% tax rate, that extra money would be at half of that.
16%.
Very good. Good math.
I can do divide by 2.
You like the numbers more when you're saving it than when you're making it. I don't know. Is that right?
I don't know. I like the numbers when we can do them simply, when we don't have the point whatever at the end.
Yes, okay. So Candace, it's not always about the money or the numbers, is it?
No. So it's about helping people move forward with their goals and also the people, really. And so doing what makes sense for them in their situation. And so we look at that with their investments, with their purchases, with their selling as well. Is it the right time?
That's awesome.
Because if you don't have peace of mind, you got nothing.
Right.
So our goal is, as always, thriving, helping you and helping ourselves even thrive in life and at home, and really getting to move forward together.